Hey everyone, GDP came out this morning and it was too damn hot. So what does that mean going forward here? The expectation on the street looks to be around 4.7%, but we came up a little bit too hot at 4.9, and you're seeing the market react appropriately to such things because, as you guys know, if the economy is too hot, even with all this pressure we put on it with higher interest rates, that means that the Fed will probably have to do at least one more interest rate hike, even though we still haven't felt the full force from all of the hikes that have been passed on from last year, okay? So, what happens next year, guys? With one more rate hike, we're probably going to see the market continue to fall over the long term here, okay? I'm not talking about a few weeks from now, but like over the next few months, you're going to see we're at a lower place than we were today. People are still struggling even with the higher GDP, which is making people kind of question what the hell is going on here, because you could have a nice job, you could be getting paid well, but you still can't afford all of the basic necessities because of higher prices. And that's the thing here. If the economy is still too strong, that means inflation really doesn't have a reason to come back down to that 2% target level. So as the economy still continues to slow here, we've seen it with layoffs and people not spending as much money, and people honestly running out of money to spend because their credit cards have been maxed out. What you're going to see is people spending less and less money, but still those restraints coming from a higher interest rates, those are still going to be squeezing the economy further and further and further until most likely now, I would forecast we're probably going to go into a recession with about a good 80% certainty. I wish it was a little bit better, but people are running out of money. And you're seeing that without a lot of these earnings plays here. Corporations are not running out of money. That's something important here. The big players, they are still spending tons and tons of money. So all of the earnings are looking not great because the consumer is struggling, but at least there are some companies that are still managing to find ways to not crash and burn, so to speak, right? We have those big companies like the Apples, the Microsofts. Those are still doing fine relative to everything else. But then you got things like Warner Bros. Or Target or Macy's, where they're down below 2020 COVID levels. Know that crash? They're below that even right now. So what you guys need to plan on for now is just choosing which stocks you guys want to choose for the long run, which ones guys want to buy. For me, those are usually going to be energy stocks. Those are going to be companies that I think will survive a recession and come out better on the other side. Usually, to be safe with these types of things, you want to choose companies that have a strong history of making large amounts of money and not being in debt. If you guys hadn't noticed, with an interest rate so high, it makes it much more expensive to actually have debt. Look at your credit cards. If you guys don't pay off your credit cards every month, normally you guys are going to see that bill go up and up and up because it's getting more and more expensive to actually own debt. So what people are going to be doing right now is doing everything they can to pay off such debt. Now, we even had good numbers when it came to jobless claims. We had 210,000 claims, and the expectation was 207,000. Right in that sweet spot there. There was no big surprise as far as I'm concerned. But again, it was not anything that would cause you to worry. And the more good news we have, the worse that's off for the economy, because that means inflation is still going to be sticky and it's not going to be going away anytime soon. So just be aware that over the next few weeks, we're going to have more inflation reports. I think tomorrow, if I can actually go over here very fast. Yeah, tomorrow we have the PCE index, the core PCE year over year. Those are going to be some inflation data that is going to be crucial for all of us, because if that's not good, we're going to have a flush out tomorrow. And I think tomorrow may even be a good opportunity to start buying back into the market here if you guys are looking for some opportunities. A lot of things are hitting levels of support. The indexes themselves are not, but individual stocks are. So I'd be going more for stocks. Or you might just want to wait for SPY to kind of finish its fall sometime mid next week and then start to climb up on some SPY calls here. But take your time. We're not in a good spot as far as the economy is concerned, and that's what's driving everybody nuts. High GDP normally is a very good thing, but we have high GDP, and that's causing inflation to stay elevated as well. And that means everyday people like me, you, your mama, your grandma, whoever, they still can't afford to buy those basic goods, which is going to be a travesty here as we start heading down into a recession where people aren't going to have their jobs and they're still going to have to face those high prices. Thanks. Today's video is sponsored by Fairdesk, a premier crypto exchange specializing in futures, spot, and copy trading.